Sorry, all seen the screen? Yes, friends.
Yes, sir.
Yes, sir.
Okay, I think we had come up to this point. Now we'll go further. Another question they will ask is economic equity capital or economic equity ratio. Both are same. That is different. RARAC is different. That is calculated using a very high complicated formula. But this is simple formula. Economic equity capital. So this is how it is calculated, Total equity, okay, simple. Like our, for the bank, economic equity ratio, EER, sometimes they will ask, economic equity capital. So that means total equity you find out. Total equity here is 180 crores and total assets are all assets you have to add here. Not only yielding assets, non-yielding assets. What does it mean? With 180 crores capital, how much assets is the bank is managing? How many times? Or the capital is what percentage of total assets? The capital is what percentage of total assets? So the total assets, if you total it, all assets, here you have to add all assets. 2160, capital here is 180, just divide 180 divided by total assets, it will become 8% or it will become 0.08. When you convert to percent, it becomes 8%. What does it mean? With 8 rupees capital, bank is managing 100 rupees assets. With 180 crores capital, bank is managing, or this bank has managed to create 2,160 assets. So how many times? I think it is 12.5 times more than that. In percentage time, the capital constitutes 8% of the total assets. This is called what? Economic equity ratio or economic equity capital. Just to keep it in mind. Normally now, okay, but anyhow, don't take a chance. The formula you understand. Agreed, friends? Now we'll move little further. Positive gap, negative gap. Here in balance sheet management, definitely there will be one question on gap analysis. One question, or it may be a 5-mark question, sometimes 2 5-mark question also. One point of time they are asking. That is maturity buckets. You have to analyze the maturity bucket. What is positive gap? What is negative gap? For example, note down. There is maturing assets. Note down always maturing assets, that is inflow. Maturing assets means what? Either repayment of loan or maturing investments. You have made some investment that is now due, some housing loan, term loan, the repayment is there. So that repayment has started. So the inflow you are getting. Okay. So maturing assets, that means 1,500, the bank is getting inflows. The bank is getting, yes, maturing liabilities mean outflow. So the bank has to pay back maturing deposits, and there will be a, yes, you have to pay back all the deposits that have become due, you have to pay back, and pre-closure of deposits. Some deposits will be pre-closed, and that will be treated as what? Outflow. These two things are inflows. These two things are outflows. That is, bank has to keep money to pay to the deposit side, and pay to the premature closure of deposits. Okay. Now here, maturing assets in one bucket. They will may not give bucket. It may be overnight bucket. It may be 1 to 14 days bucket, or it may be 1 month bucket. It may be 1 year bucket. No problem. Whichever be the bucket. Inflows are 1,500, but outflows are 950. So here it's a positive gap. Now the positive gap easily can find out, but you have to analyze the implications. You have to analyze the implications. Supposing there is a positive gap, there is a upward trend in interest rates. What will be the impact on NII? This is a question they will ask. Positive gap, negative gap, you can understand. But to find out positive gap, negative gap, you should be very clear. What is the inflow? What is outflow? So these two things are inflows. These two things are outflow. Agreed? Supposing maturing assets. Yes, even maturing liability or outflows also you can add. Any new loan you are dispersing, that is also outflow. Okay. So any yes, loan getting repaid, that is all repayment in loans, inflow, outflow. So here it is positive. Okay. For example, why positive? Bank is having more inflows. So these funds are available at the hands of the bank. Bank can do anything. But negative gap means, next question you see, negative gap. What is negative gap? Maturing assets, that is inflows are 1,200 in one bucket. Maybe next 1 week, 1,200 crore the bank may get on account of repayment in loan, on account of maturing investment, but the bank has to pay back to depositor, pay back, they have to fund their premature closure, 1,550. So that mean it's a negative gap. Positive gap will not create a problem, but negative gap will create a problem for the banker. Why there is a negative gap creates a problem? Because you should keep arrange funds to meet the deficit. Okay, it is as good as family income is more mean you need not have to worry. Family income is less, but family expenditure is more. Necessarily, the family head will be worried. Similar way, inflows are more, no issue at all, positive. But inflows are less, outflows are more in a particular time bucket. That is called negative gap. But when there is a negative gap, then you have to find out what percentage is this compared to outflows. So here 350 is the negative gap. The 350 crore constitute 1550 into 100%. That is a percentage. That means 22.58%. Oh, that means what? 22.5%, 58% is the negative gap. For negative gap, in some buckets, RBI is giving a prudential limit because your negative gap should not go too wide, too big, because that will create a liquidity risk for the banker. Agreed? Okay. So now what is negative gap? You understood? So negative gap, positive gap. This is not the question. I am preparing you for the final question. Okay. What is negative gap, positive gap? What they will do? They will give some cash flows. They will give some cash flows, or they will give a chart. From the chart, you have to find out whether it's an inflow or outflow. Easily can find out whether it's an inflow outflow. Inflows are mean positive. Outflows are more mean negative. Agreed. Now you go to now the impact is now is a technical question. Positive gap in 1 year bucket is 300 crores. Interest rate goes up by 50 points. 50 points in half percent. What will be the impact in NII? So the answer is okay. So the answer has come. Okay, I am not animated. So the answer has come. Is a positive gap. Positive gap in 1 year bucket, 300 crore. Example I am telling. Okay, what does it mean? The bank has got surplus funds 300 crore in this 1 year bucket. That means after meeting all the deposits, withdrawal of funds, disbursement of loans, everything, the bank is likely to have surplus funds that is positive in the hands of the bank, 300 crore. Now interest rate goes up. Interest rate, all general floating. Now 300 crore has to be invested. Now interest rates are going up. Now it becomes a profit or loss. It becomes a profit. Okay, why profit? The 300 crores can be now invested in a higher interest rate because interest rates are going up. Housing loan interest is going up. So I will give now fresh housing loan. I will get more income, 50 points. 50 points mean half percent. So that way your NII will go up. How much will be the profit? 300 you put in. This is the question they will ask. 300 you put in. That is the gap. Okay. Positive gap, negative gap, four scenarios are possible. I will give a summary. Positive gap, negative gap, four scenarios possible. What is positive gap, negative gap? In a positive gap, interest rates going up. What is the impact? Positive gap, interest rates coming down. What is the impact? Negative gap, interest rates going up. What is the impact? Negative gap, interest rates coming down. What's the impact? There are four possible situations. This you have to keep in mind. Don't memorize. You have to apply your mind. So first thing I have told, if there is a positive gap, interest rates are going up, it becomes a profit. How to calculate the profit? 300 into 0.50. Okay, 0.50 divided by 100. So that means 1.5 crores. So because of the changes in interest rate, bank is going to have more income, that is interest income, 1.5. So the NII, what is NII? The NII will go up by 1.5 crore. That's the answer. How many of you understood? All of you understood or not? Yes, friends. Shall I give the next question?
Yes, sir.
Yes,
Yes,
sir.
sir.
Yes, sir.
Okay. Now next question. Positive gap. Okay, same positive gap, 300 crore. Now, interest rate goes down. Interest rate goes down by 1%. Now, what will be the impact in NII? Now, you have got 300 crore, but now the interest rates are not going up, it is coming down. Housing loan interest. So, you have to invest these funds at not a higher interest, lower interest. Then automatically it becomes a loss. This is how you have to run a video in your mind. You are having funds, okay, positive. Now we have to invest that funds. Bank cannot keep any funds idle. Okay, money has to be invested. So the bank either they have to park in anywhere. So the interest rates are now going up. So because of sorry, now interest rates are going down. So this 300 crore now in this changing scenario, if they invest, it will result in loss. How much loss? Because interest rates are going down. So positive gap, you invest today, you will get lesser income. So your NII will be reduced by 3 crores. Understood? Earlier, you told profit. Now you are telling loss. How much loss? Gap into just 1%, 3 crores. Okay, 1% mean divided by 100. 1% mean always divided by 100, or you have to put 001. You have to convert to decimal. So 3 crore will be the impact in the NII. Impact means the NII will now come down. Your net interest income will come down. It's a literally is a loss. Now next question you see negative gap. Now you are coming to negative gap. Say 1 year 500 crore negative gap. That means bank has to mobilize 500 crore. Bank has to mobilize 500 crore. Now interest rate goes up by 1%. Now bank has to mobilize, but you have to get that funds from the market. Now you are not investing, you are going to borrow. Please remember, in a positive gap, you are having money. In a negative gap, the bank, you are the treasury manager. You are all assume you are the GM of treasury. So your bank is now having a negative gap in one bucket. Now you have to arrange the funds. You have to arrange the funds. When you have to arrange the funds, now interest rates are going up, then it will result in what? Loss. Because you have to arrange the funds at a high cost. Because going up. Okay. So the rates are going up, and negative gap means it's a loss. Negative gap, interest rate going up, loss. How much loss? 500 into 1%, 5 crores loss. This will be the question they will ask. Okay, when they, I will give you a summary, then you will understand. Okay, then the fourth possible situation is negative gap 500 crore, but now interest rates are going down by 0.5% or 50 points. Either they will use the word 50 points or they will use the word 0.5% of percent. Now, what will be the impact in the NII? Now, it's a negative gap. You have to arrange 500 crore. But luckily, now the interest rates are going down. So you can get those funds at a still a lower income, lower interest. Because interest is going down, So it indirectly becomes a profit. Indirectly, it becomes a profit. Because the interest rates are going down, I will get the 500 crore at a cheaper rate. So cheaper mean indirectly it becomes a profit. Notionally it's a profit. How much profit? 500 crore into zero point 0.5, that is 2.5 crore in this scenario. In this scenario, it's a profit. Now, have you understood or not? Now, I will give you four situation. Four situation you have to keep. You don't memorize it. You should not memorize it. You should apply logically. You have to understand. Okay, I have not animated. Okay. Now, positive gap. Okay, it's a summary. Positive gap. Positive gap means banks are having money in a particular time period. Now interest rates are going up. So you can invest in a higher rate. So it is a profit. Agreed? So this is how you have to run a video in your mind. Oh, this is how. Okay. Don't memorize. Positive gap, interest rate for loss. No, no, no. If you memorize, you will not be able to remember in the exam. This is how you have to. So negative, positive gap in bank is with money. Now they have to invest that money. And when you invest in that money, interest rate is falling, then it becomes a loss. Interest rate is falling, then it becomes a loss. Notionally, it's a loss. Yes or no? Next, negative gap. Negative gap means what? Bank has to arrange the funds. Negative gap. Negative gap also is RSA, RSL. They will use the word RSA, RSL. What is RSA? Maturing RSA. Risk sensitive assets. Maturing RSL. Which has to be more? RSA more mean you are getting inflows. Anything, assets, RSA they will use, or funds they will use, inflows they will use, outflows they will use. Anything you have to remember. Okay. So negative gap arises when outflows are more than the expected outflows are more than the expected inflows, it becomes a negative gap. Now interest rates are rising. Negative gap means you have to arrange the funds. Before arrange the funds, interest rates are moving up. Then you have to arrange at a high cost. Then it's a indirectly it's a loss. Now negative gap, you have to arrange the funds. But luckily, interest rates are falling. Now we can get the funds at a cheaper cost. In other word, indirectly, it's a profit. So two scenario profit, two scenario loss. This is the thing you have to remember because questions will be there. How many of you understood? Yes, boss. These are the question. Two questions will be on this. Two questions on impact in NII. When the interest rate goes up, what is the gap they will give? Okay, understood or not? All of you understood? Yes,
Yes, sir.
boss.
Yes,
Yes,
sir.
At
sir.
least
Yes,
one
sir.
of you.
Sir.
Tell me
Yes,
once
sir.
Yes.
Yes,
again,
sir.
sir, what terminologies they will use to for these questions like RSA, RSL? What? Please, can you repeat that full form?
Um, Madam, RSA mean risk sensitive, or they will tell maturing assets. You can note down the positive
हाँ
gap,
हाँ
how they will display. No, madam. RSA
हाँ
mean risk sensitive. They will use this word. Positive gap, you can note down. Positive gap mean maturing assets are more than maturing liabilities. Note down. You note down, madam. Then you will
yes
understand.
yes sir.
When you note down
Maturing
in your own
assets.
handwriting, it will go into your
Yes
mind. What is considered as positive gap? Maturing assets. Maturing assets mean inflow. Within bracket
yes
inflow you put. Maturing
hmm.
assets mean inflow more than maturing liabilities. Maturing liabilities are outflow. Then you tell me it's a positive. You can easily remember. What's the
Yes.
positive gap? Maturing assets
Maturing
are
assets
more
more than
than
maturing
maturing
liabilities.
liabilities. It is a positive gap. Okay, understood? Okay, now come
Yes.
to yes. Now positive gap only this much. Negative gap. So positive gap, two scenarios are possible. What is positive gap? Two scenarios are possible. Interest rate may go up, interest rate may come down. What is negative gap? You can note down. Negative gap means maturing assets are less, maturing liabilities are more. In other words, maturing liabilities are more than maturing assets. Okay. What is or in other words, they will give outflows are more than inflows. Either way, they will give the question. Maturing liabilities are more than maturing assets, then it's a negative gap. Or outflows in a particular bucket more than the expected inflows in that bucket, then also negative gap. Which is more? Outflows are more mean negative. Inflows are more
Negative.
mean positive. This is how you can exam they will give. How the exam they will give, just wait. I will give a live example. So now the four
Yes.
concepts you understood or not, this will help you to do a arithmetical problem. Okay, how they will give, I will give a lot of example. Now you have to do gap analysis. Now you are coming to the other concept. Always balance sheet management is nothing but mismatches in maturity buckets. Okay, well, remember, bank is really doing a circus. What is a circus? Our deposits are accepted up to 10 years only, maximum 10 years. Current account, SP account, withdrawable on demand. Immediately, anytime they can withdraw. But what you are doing, you are giving housing loans for 30 years, 25 years, then it becomes a mismaturity. Your ALM is under some mismatches are there. Agreed or not? Yes, madam. All of you are aware of this? Yes.
Agreed. Yes, sir.
Yes. Our deposits are in different maturities. Our loans are in different maturity. So as a banker, you should be positive gap, you need not have to worry. But negative gap should not spoil the image of the bank. Negative gap is there, but your ability to manage the negative gap, if the bank is unable to meet the deficit, then it becomes a risk for the banker. That risk is called as liquidity risk. Okay. What is liquidity risk? If you are unable to fund the expected outflows, there may be so much withdrawal. You cannot stop. It is their deposit. They are withdrawing. Okay. So bank, yes, has to arrange funds and allow the withdrawal. They cannot tell, no, I will not do it. I will not allow withdrawal, mean image of the bank will be damaged. So the liquidity management is very crucial in balance sheet management of the banks. Now you come to the question. Normally the focus will be on first 30 days. Either it is 28 days or 30 days. Supposing some banks becomes a problematic bank, I think all of you have seen the news. Some cooperative bank, there will be uh, some problem. So the cooperative bank, because they have given more NPA, so everybody thought this cooperative bank will collapse. So many people stood in queues. They started withdrawing, but the cooperative bank did not have enough liquidity to pay back to the depositors. Similar scenarios should not come to the bank. So that is why Basel III tells, yes, especially first 30 days, that is called as stress period or critical period. Okay, so here you have given a data, gap analysis in ALM, a case study. Very simple only. 5 mark question they will give. But if you understand the concept, easily can do. For example, yes, here they have grouped already. Inflows, outflows, they have grouped. Sometimes they will not group like this. They will only tell maturing assets in overnight 150 crores. So maturing assets mean always inflow. The interest due, the interest due to the bank, not due from the bank. Interest dues, bank has to earn some income on account of investments made to the government of India. So government of India, interest they are paying. So the interest due is inflow, 40 crores during overnight. Overnight means next day. Next day, repayments expected by a bank 150 crore. The interest payments receivable, interest receivable expected 40 crore. The assets, they are going to sell some assets. Assets mean some bond they are selling, some commercial paper they are trading. So that is also assets. Okay. So the assets they are selling. Sometimes NB also they are selling. Please remember, NP also they are selling to another bank. That is also a new concept. So the sale of assets will result in what? Getting money. So all these three heads, 250 crore they are getting in overnight. Overnight means 1 day. Next is 2 to 7 days. Next is 8 to 14 days. Next is 15 to 28. Up to this 28 or 30, this is called as the critical period. During this critical period, that is, the bank in problem in first 30 days you have to manage carefully to preserve your image. Afterwards, I think it will be settled. Central government, state government, something, paper, everything. Before the situation goes worse, managing the liquidity, that is important. So normally the liquidity in this ALM exercise, maybe for full 5 year also, different example also I can give, but to make you understand in a simple way, I given a simple case. Okay, so now understood. So overnight inflows how much? 250 crore. But overnight, that is next day, the next working day, the bank is having maturing deposit 55 crore. Some deposits are going to mature. SP account withdrawal 15 crore. Current account withdrawal 20 crore. Interest payable, you have to pay interest to the depositor, that is cash outflow. So the outflow 80 crore. So the A is 170 crore. Outflows are 170 crore, but inflows are 250. Now you tell me, is a positive gap or negative gap? It's a positive gap because inflows are more. So you come to the question, in which bucket? So every bucket, these are the questions they will ask. In which bucket the negative gap exceeds RBI prescribed limit? What is the percentage of negative gap in 2 to 7 days bucket? Okay. Uh, what is the percentage of negative gap in 2 to 7 days bucket? Whether it is within the RBI limit, in which bucket negative gap is within RBI fixed limits, in which bucket the negative gap should be within 20% of the expected outflow, and what is the gap in 8 to 14 days bucket, whether within RBI limit. 5 mark question. These are the 5 mark. Simply you can do. You need not have to worry at all. 5 out of 5 you can get. You should not miss any. Okay, you need a paper. All of you
Sir,
need take a
what
paper.
is RBI prescribed limit, sir?
Wait, madam. RBI prescribed limit 555. You have to add, madam. First overnight 5%. Okay, easily can remember. First overnight you should not exceed 5%. Next bucket another 5. 5 plus 5 10. Another bucket 10 plus 5 15. Last bucket 20%. This is the crucial. That is cumulative. Cumulative. Overnight 5. Cumulative. Cumulative means what? 1 to 7 days. This is 1 to 14 days. This is 1 to 28 days. This is cumulative. Cumulative means what? You cannot see. Okay, though it has been classified at 4 different buckets, you have to see totally. That is called cumulative. Cumulative means just wait. We'll see how to calculate the cumulative cash flows, cumulative gap. Cumulative means you know very well. Cumulative means added to each other. Okay, it's a standalone gap. Overnight is a standalone positive. But when you mix up with others, it is a different scenario. What's the RBI rule? Easy remember. The negative gap should not exceed, note down, the negative gap should not exceed in overnight bucket 5% of the expected outflow. What is the outflow? Outflows are 170, and on that 5% you should not exceed. The negative gap should not exceed 5% of the expected outflow. Similar way, 2 to 7 days bucket, RBI guidelines are is the negative gap. Negative gap if any. Here it's a negative gap because inflows are 280, outflows are 300. Now what is the negative gap? 20 crores.
20.
But what is the percentage? 300 divided by 20. 20 divided by 300 multiplied by 100. Tell me what is the negative gap in percentage? Tell me, friends. Any of you can tell.
6.66.
6.67. Okay, 6.67. Now, whether it is within the RBI limit? Yes, it is within the RBI limit. Why? Here 5, here 5 plus 5, 10. Oh, very good. In this bucket, the negative gap, but the negative gap is well within RBI prescribed limit. Okay, we'll go to next bucket. Next bucket, inflows are 400.
Whom we will divide with the limits.
Madam, note down the gap, the negative gap should be divided by outflows, not inflows. Then you apply percentage button. You take
I'm asking about the percentage. I know the 6.6 is come. I know this.
Okay.
After that, the 10% we are maintaining.
That 10% they will not tell, madam. You have to keep in mind. The 10%.
So that 10% on which we see that this is falling off what?
No. RBI
rules.
prescribed negative limit is not to exceed 10% of the expected outflow. Now in this
Outflow.
outflow. 10% of what? Expected outflow. 15% of what? 15% expected outflow. All the percentage will be, the negative gap will be in relation to outflows, not inflows.
Means the outflow will come 30, or we are getting 6.6. It means that it is under that.
Under RBI. Okay, very good. Super. 2 marks assured, madam. Don't worry. Now you come to third one. 400 crore is the inflow. But 500 crore is the outflow. Now tell me positive or negative.
Negative gap.
Negative gap.
And
Then what is the percentage gap?
20%.
20.
100 divided by, not divided by 400. 100 gap divided by 500.
20.
100 divided by 500, 20. Now tell me whether it is within the limit or
No,
out.
sir.
No, sir.
Huh?
No,
No, sir.
No, sir.
No,
Limit
it
is 15 and
yes, limit is
Exceeding, sir.
15. So it is 5% more than the RBI prescribed limit. Very good, super. Now come to the fourth bucket. Okay, yes, fourth bucket. Inflows are 450. Here they have given inflows correctly, but in the sometime they may not give. You have to only identify. For example, maturing assets only they will tell. Now you have to whether it's an inflow or outflow. I think by practice it will come. Okay, mature deposit outflow. Maturing SP, withdrawal from SP, outflow, like that. Okay, so here 450 is the expected inflows, but 400 is the expected outflow. So that means it's a positive gap. Positive gap, don't worry about the RBI guideline, because the RBI guidelines are very strict for negative gap. Here is a positive gap. What percentage and all, don't worry. Okay. Why you need not have to calculate positive gap? Don't worry. Now you can
Sir, no need to calculate cumulative gap, sir.
Cumulative gap you have to calculate. Cumulative gap, how much?
No need to calculate, sir.
No, calculate. The question if they ask is you have to calculate. So you now note down. You can easily by memory. So first gap, how much? Positive or negative? It is positive.
Positive.
So you put plus 80, you put plus 80, you put plus 80. Okay, it's a positive, no? Second, you put minus 200, you put, minus 20, you put. Here it is plus 80. Here it is minus 20. Here it is minus 100. Correct? Here it is quantum. Here it is what? Plus 50. Now totally find out cumulative gap. Cumulative gap. This is cumulative gap. Cumulative gap means here it is minus. How much it is coming, boss?
Positive 10.
Huh?
10, sir. Finally.
10, yes, that's all.
Positive.
So cumulative gaps they ask, yeah, which bucket positive, which bucket negative. So each bucket you are calculating separately. Then you add, okay, adjust the negative, positive, negative. That will be considered as a cumulative gap in 1 to 20 days bucket. 1 to 28 days bucket. Agreed or not? Okay. Now come to the actual questions. Okay. Working sheet. So working sheet you take. So first already you have agreed positive gap 80. So second you have agreed positive negative gap 20, but percentage wise 6.6. Very correct. And third negative. How much negative? 100 crores negative. The 100 crores is 20% of 500. 500 divided by 500, 20%. So it is beyond the limit. Okay. Now you here positive gap 50. So the cumulative is 80 plus 50, 80 plus 50, 130, 100 plus 20, 120. So the cumulative gap is positive by 10 crore. Positive by 10
Sir,
crore.
only for negative things we have to do that 20%, sir.
Yes. Madam, the RBI guideline tell you are happy, bank will be very happy, very stress free. You don't have any stress, you know. If you are earning more income, where is the stress? But when you are earning less income, only problem arises. So the bank.
Sir, can you explain that RBI threshold limit for each buckets if it is a
Yes.
negative gap?
Yes. Boss, first easy to remember, they have designed such a way.
Sir, in
Overnight
between
gap,
you are telling positive plus 10. What's that? Plus 10.
that is cumulative, madam. Cumulative means in one bucket 80 crores positive, next bucket 20 crore negative. So you all this you adjust, you know, then it become 80 plus 50, 130. The 100 minus 20, 120. So overall, if you see, it's a positive gap. But positive by how much? 10 overall. Overall, that is called as cumulative gap. But you have to analyze the yes. Per gap they are giving. So per gap different. Overall, that is called cumulative gap. Okay, depending on the question. The question, how they are asking. Here the question is, we will come to the question. Okay, now his question is, what is the question, boss? Somebody put one
Sir,
question.
that RBI threshold
In
limits
which
for
bucket?
each bucket.
Made overnight bucket not to exceed, not down. Overnight bucket not to exceed 5% of the negative bucket. The threshold limit is only for negative limits, negative gap. Okay, it should not exceed overnight 5% of the expected outflows. The negative gap, if any, should not exceed 5% of the expected outflows in that particular bucket. Overnight, 5%. Next, either you call it 2.7 or 1.7. It's a cumulative bucket also, you can tell. The 2.7, another 5. So cumulatively, 5 plus 5. So they will, RBI will ask, in 1 to 7 days bucket. In 1 to 7 days bucket, 5 plus 5, 10%. The prudential limit is the negative gap should not exceed 10% of the expected outflow during that period. During that period mean not overnight. During that period mean 1 to 7 days. Next bucket is, next threshold limit by Reserve Bank of India is the third gap, level. What is the third level? In 8 to 14 days bucket, another 5% will be added. But
15.
when you see from 1 to, so 1 to 14 days, the negative gap, if any, should not exceed 15% of expected outflow during that bucket, during that cumulative. The 5 will be added, 5 in isolation, the 15 in together, cumulative. Then last bucket, any, yes, negative gap in 1 to 28 days. Now it is all will be added. Negative gap in 1 to 28 days, okay, should not exceed 20% of the expected outflows. 20% of the expected outflows during that bucket. During that bucket means now we are combining all the bucket 1 to 28. So 5, 5, 5. So easy to remember. 5%, 10%, 15%, 20%. Agreed or not? Easily understood or not?
Sir, for every
the
interval,
negative gap
it
we
will
need to
be like
adjust, sir.
this.
Yeah?
That
For
negative gap
every-
we need to adjust, sir.
Yes. But they will not ask for every isolation, they will not ask. First, they will ask up to 28 days. Up to 28 days means naturally 5, 20%. Up to 1 to 14 days means naturally 15%. Yeah, that is one bucket isolation 5, One bucket in isolation 5. But they will not ask per bucket. So normally up to 1 to 28 days, yes, the 20% is the prudential limit. Negative gap
Sir,
should not
in
exceed.
another question, the pool is different. Something like the days varies and the bucket varies. This 5, 10, 15, 20 cumulative will be the same.
Yes. Okay, this RBI limits, madam. RBI limits, accordingly, they will give some questions. And this is a question, you know, now we'll analyze, the questions we'll answer. Yes.
Sir, sir, one,
6.66% came, sir.
sir, one doubt, sir.
Ah.
Sir, if it is a 1 to 14 bucket, 1 to 14 days bucket, it will be for 15% threshold limit.
No, 1 to 14 are correct, 15%. 1 to 28, 20%. 1
Okay, sir,
to
thank you.
overnight, 5%. 1 to 7 days, yes, 10%. Correct, you are correct. Okay.
But in this
Now,
question, 2 to 7 days, we have taken 20 only, no, sir. 2 to 7
yes,
days,
madam.
how much we have taken, sir? 2 to 7 days, how much we have taken?
2 to 7 days, na, madam.
10%.
2 to 7 days, 10 mean, that mean it stretches from 1 to 7 days, madam. Though it is shown separately, the question, okay, it means literally, practically, it is 1 to 7 days. Okay, 2 to 7 days is a separate bucket. But RBI, earlier all were in single bucket, friends. Now RBI did, I think earlier
Correct,
it was
sir.
up to 14
That
days.
20, 10% we have to make it, no, sir. Then
20?
here in the worksheet, negative gap is 20. How we got that 6.66?
Oh, acha. Oh, this is, no, madam. 20 is the gap. 20. What is the 20? 280 minus 300. 20 is the gap. 20 divided by 300. 20 divided by 300 means 6.66. The outflow, we have to, the gap and related to outflow percentage.
Sir, if
Okay.
exceed 10% means what, sir? What will do, sir?
Which one?
If exceed 10%, 1 to 7 bucket.
Okay. Then a bank has to arrange the funds. Bank
Arrange
has
the
to,
funds. Okay,
yes.
okay.
Bank will do a
Okay.
swap transaction. Please
Swap
remember,
Okay,
some funds in another bucket, they will transfer to this bucket because bank will provide fund and they will minimize the gap. Bank will minimize.
Okay.
That is how
Thank you.
bank is, no bank will go beyond this RBI. But whenever a gap is going to be beyond that, they will do a swap transaction. What is a swap transaction? Some buckets will be surplus, you know. Some buckets will be surplus. That they will
Yes, sir.
realize. Okay, supposing government securities are there in 5 years, that they will realize now, and then they will put it in that. Some investment they will realize. Like that, they will, bank will
Then
manage.
only for those two, why we have calculated, sir? Remaining first one and last one, why we have not calculated?
Which one, madam?
That
One
percentage,
Positive
that percentage
Positive
madam,
gap.
positive
RBI
don't
consider
forget.
only negative.
RBI is applicable for negative gap only. When there is a positive gap, you are under no risk, you know. For the bank point of view, there is no risk, liquidity risk. Okay, liquidity risk means that is also a problem. Okay, managing more money is also a problem, but the gap analysis is mostly applicable for negative gap. Positive gap means be relaxed because your inflows are more. Okay, madam. So this
Sir,
is how
last
you
question, what for
Sir,
the
this will
threshold
be
limit for
calculated on
we-
daily, sir, or monthly?
not daily. This will now nobody calculates because it's all automated. Now the software packages has been designed. So any point of time they will come to know everything, maturity, mismatch. Those days bankers used to calculate manually. Now all are programmed, you know. So next to tomorrow, what is the maturing asset? They will know, boss. Tomorrow in next week, what are the maturing
Okay, sir.
assets? They will know. What are the maturing liability? They will know. Okay, but some maturing liability may be renewed also. Some deposits may be renewed. Sometimes some maturing assets also, there may become a NPA. So that mismatches in cash flow, automatically this software will recognize. Now everything is in a computer's environment. No? Yes, madam. Understood or
Thank you,
not?
sir.
Sir, the threshold limit, why we will use, sir? How we will use?
Madam, threshold limit with regard to the expected outflows, madam. Always remember, for example, one second, I will give next, then you will be, one more example I am going to tell you. Then you will be alert, oh my God, why the threshold limit is very relevant. The threshold limit is why relevant, you know. Your question is very good. To manage, yes, because 5 and all, okay, easily can manage. But the gap is wide, you know. So the bank is exposed to a risk of not being able to meet the liquidity. So that is why they are cautioning. It is within the manageable level, okay, but it is beyond that. You have to make it within the limit by doing any swap transaction. The maturity adjustment they will do. The maturity adjustment they will do. That is that they will do at the corporate level, madam. No problem. But for exam purpose, these are the questions. Understood, madam? Okay. Now 26. Okay, you have now understood which bucket RBI succeeded 8 into 14 because fixed is 15, but it's already 20. So like that, all questions you can answer. 27, 2 to 7, whether within RBI limit, yes. In 2 to 7 days bucket only, that is cumulatively. Though the question is 2 to 7 because they have given, but really speaking, it is 1 to 7. So the bucket is the limit is for 10%. So the limit is it is within the limit. So 6.6. 6.6
Sir,
how
within
much?
the Sir, within the limit or not, we have to find out from the percentage, not from the cumulative gap, no, sir, from only from the
Yes,
gap.
yes. Every time you have to calculate what is the outflow, what is the inflow. Outflows are mainly negative. And the
No,
percentage will be
finally, when we are
always
calculating the percentage, we have to take the cumulative gap to the total outflow or gap to the total outflow.
cumulative when they ask only, madam. But when they are in the particular bucket, for every bucket, why they are giving the inflow outflow? Because you have to know what is the inflow outflow in each bucket. But why they are asking the cumulative? Sometimes some buckets it will be positive, some bucket will be negative. Overall only, then they will ask a question: what is the cumulative gap? But each bucket you have to be sensitive. Each bucket you have to sensitive. The sensitivity is there up to normally up to first 30 days. Every month it will go on changing. 30 days is the critical period. Okay, understood? Okay. So like that, this is a question they may ask. This is how you have to answer. 5 mark question you can answer. Now we are having a change. Gap analysis, one more I will give, don't worry. One more I am giving because quick revision. Okay. So one more I will give you. So before that, one small exercise. Okay, NPA management. 5 mark, again 5 mark. You see the question. There is one international bank. They have provided because NPA also provision coverage 7-8 marks may come, but I am giving you 8 question. Easily you can calculate. Now all of your alert mean you can easily tuck 5 mark. You can easily get. You see, this is a case study. The total advance of a bank 40,000 crore. You have given the data. Cross NPA 9%. Ready with the pen and pencil. Okay, sorry, pen. Okay. Total advances. Okay, but before friends, please remember, yes, please be in mute mode when you answer only. Okay, otherwise, all no. If you keep everybody is unmute, mean then it will be yes, noise will crop up. Okay, please help us. Okay, the total advance of 40,000 crore, gross NPA 9%. This is the data they are giving. Net NPA 2%. Based on this information, answer the following. It's a beautiful question. Okay, I think similar questions are being asked. Not because nobody gets the question correctly, because everything is secret. So based on what we interact, we sometimes we build up the yes case study. Okay, you understood the data. Only 3 data they have given. Total advance of 40,000 crore. Gross NPA 9%. So immediately, what's the NPA? Whether anybody can tell what is the NPA? Yes, boss. What's the NPA right now?
Yeah,
Challenge.
90
Okay.
days.
3,600.
3,600. Very good.
And
3,600
800.
NPA. Okay. Now net NPA 2%. Now net NPA means how much? 2%. Now can anyone tell what is the total provisions? Okay. 8,000. Okay. Now can 800. Can anyone tell what is the provisions available? What is the provisions available? Immediately can you tell? Bullet answer.
2,800.
All right, great. 2,800. How you got it? Because the difference between net NPA cross
Plus
NPA
minus
that
and
is
net.
7%. So 7% into 40,000. 2,800 is the provisions available. Very good. Now you have to answer the question easily. You can answer. Number again, one more data they are giving. Consider all their standard loan account. What is their standard loan account? Standard loan account is 91%. 9% NPA mean that it mean 91% of the loans are standard. Agreed? Huh? Okay. Now they are telling all the standard loan account represent general advances. Okay. Well, all of you remember, even for standard assets, you have to provide. Provisions are required. Note down SME 0.25. I am giving separately 0.25. Agri loan 0.25%. Okay. All general advances 0.40. Real estate 1%. Housing, real estate housing 0.75%. This is the provision even for what? Standard assets. Okay. Now the question is, considering all the standard loan account represent general advances, what is the amount of provision for standard loan account? Whether anybody can calculate, it's a challenge. Whether
0.4.
anybody can calculate, 0.4. You have to calculate for standard.
145.6.
Very good. How you got it? No, 91% of 40,000 crores is standard. How you got 91%? NPA is 9% means standards are 91. 91 into 40,000, how much? I think something. On that 0.40 you calculate. So if you, I can calculate by yes. So the questions you are ready now. 5 more question you can easily answer. So 40,000 into 40,000 into what? 91%.
91%.
Yes, equal to on
Sir,
that.
all
this
the
is
standard loan
400.
accounts represent general advance.
Yes, that mean indirectly they are telling calculate standard assets provision at 0.40. That is the meaning. Indirectly.
145. 145 answer.
145.60
145.60.
is their answer. Very good. Great. Now answer one by one. Now considering 145.60, C is the answer.
Sir,
So question number 20.
how, sir? I didn't get, sir.
Madam, madam, 40,000 is the total advances, friends.
Okay.
NPA 91, NPA 9%. What does it mean? Standard advances are 91%. How much?
Okay.
100 minus 9, 91. 91 into 40,000 you multiply, madam. You multiply.
Okay.
91% into 40,000 divided by 100.
36.
36,400.
400.
These are
Yeah.
the standard assets. Even for standard assets, now you have to create provision. At what rate you will create provision? 0.40. Okay, please keep it in. Yes, mute mode. Understood. So 26 question slash. Yes. Now what is the
40
provision?
standard?
Huh?
40 is standard?
No, madam. That is only for general advances. There are 4 slabs, madam. Just wait. There are 4 slabs, but here you have to assume all standard advances are general. I think for agree 0.25, madam. Note down 0.25, MSME advances 0.25, and housing loans, real estate housing loan 0.75, commercial housing, commercial loans.
Real estate 1%.
Real estate 1%. All other standard 5 slabs are there. All other 0.40. This is the provision needed for standard assets. So here question number 1, very good, understood. Question number 2, what's the provision on NPA? I think already you have told. What's the provision on NPA? Quick.
2,800, sir.
Very good. 2,800. Click it, 1 mark. Okay. Yes. Now 2,800. Very good. How we got 2,800? 7 into 40,000. Okay. Clean. Very good. Now question number 28. What is the total amount of provisions on total advances, including standard accounts? So the 2,800 plus 145.60, both you total it. So the 2,800 only for NPA, the 145.60 only for standard. So the total provision is 2,945.60. 2,945.60. Answer is B. How? clearly. 3 marks. Okay, 3 marks laddu. Okay, 29. Okay, 29. What is the amount of gross NPA? Gross NPA 9 into 40,000, 3,600.
3,600.
600. Agreed. Now question number 30. What's the amount of net NPA? Net NPA is
800.
800 crore. Very good. Okay. Now we come to the next one. What is the provision coverage ratio for NPA? What is the provision coverage ratio? How much provision? 2,800 is the provision. But what is the note? Total NPA? 3,600.
3,600.
So into percentage mean 77.8 is the PCR. That is also called PCR. Now whether they achieved the mandatory guideline, tell
Yes,
me,
sir.
boss.
Achieved.
Have they achieved the mandatory? Yes or no? Yes, they
Sir.
achieved the mandatory. What is mandatory? PCR is
70%.
70%. So they are above the mandatory level. Very good. Last question. What is the BCR as per Basel 370? What is the minimum amount of provision to
Sir,
be
what
maintained?
is the PCR percentage?
70, madam.
Mandatory.
Yes, mandatory 70. 70% of your total NPA. Your provisions, overall provision, including standard, substandard, all put together, it should be 70% of your gross NPA. Super. All the 32 answered. So what is the minimum amount? 70. Here, how much they are having? 77.8. So all the 7 questions understood.
Sir, this 70% is including provision for standard accounts?
No. This is,
Only NPA accounts,
70
no, sir?
only for NPA, boss. Standard assets, that is considered as a counter-cyclical provision. That is a buffer provision. That is actually a buffer, or it's a over-cautious. Banks are expected to be careful, so that is why, okay. But this PCR is not including standard, only on NPA.
So it should
Agreed?
be within the limit of 70% or more than
Yes,
70%.
yes, correct. This is a simple question, but most of the people are unable to do. You see the question.
The
So,
previous screen,
The
please.
previous slide, please. Previous slide. Previous.
previous over, madam. Previous. All the NPA, they will give a case study. Any 5 only they will ask. Now 7 questions you answered nicely. No problem.
The
Understood?
previous sir, 1 minute. Previous.
Okay. You want the previous, Okay.
Yes.
Yes. Okay. I will share with you. No problem. Now I will.
These all will be shared by you, no?
Yes. I will. This is not yet shared. I will add something more in the process we discuss. I think in the morning somebody wanted yearly volatility. This much mean how to find out the monthly volatility. That question also I have added. How to find out? Yes, I will share with all of you.
Sir, this PCR should be above 70% or within 17%?
No, it should be more than 70, boss. Minimum is 70. If it is more than 70, mean it's a good sign. People are already, banks having more than 70 mean good. Minimum 70. Okay. Yes. More than
In the second
70.
question, 9 minus 7, why you have done, sir? 9 minus 2.
That is net NPA, madam. Net NPA. 9 minus 9. What is 9 minus 7? Where it is coming?
So provisions, sir. Provisions is the net.
9 minus 2.
We need to find out what is the provision, because net NPA is 2%, madam. Gross NPA 9. So the provisions are 7%. Provisions are difference between net NPA and gross NPA 7%. So provision alone 2,800. Provision alone 2,800. This is how you have to.
Sir, what is the formula for provision coverage ratio, sir?
Madam, total of provisions, overall provision divided by total NPA. Is this a question? So the provision coverage, total provisions divided by only for NPA. Provisions available for NPA divided by total NPA. Just press your percentage button. 77.8. Okay. This is how you have to calculate PCR. Yeah, every year they are asking. PCR calculate, they will ask. Okay. Now another important question.
Has
The
to
bank
be gross
has got.
NPA, sir. So total NPA has to be gross NPA, no? Total
Yes,
NPA
yes.
has to be gross NPA.
Yes,
no?
yes. That is why gross only. Gross only we have, gross only we have calculated. This is the total NPA is 3,600. The total provisions are total NPA is 3,600. No, that is gross NPA. This is 2,800 is provision alone. So that becomes 77.8. More the mandatory requirement.
But
Okay.
sir, if it's above 70% means how it will be a good sign, sir, because the
It's
provision will
not
be
a
high.
good sign. They are the bank is ready to absorb the loss. The bank is ready to, they can write back. Supposing they are able to recover something, excess provisions. I think the excess provision can be added back to they can use that back provision. Normally they are ready.
Sir, can you
Yes.
provide the provision percentages?
Oh,
Please.
yes, coming. Don't worry. Coming, madam.
70% is there.
Now, effective cost of deposits mean, what do you mean by that? Provision coverage, that is a balance sheet management. Risk weightage, risk management. Here, provision, what is the provision for standard? What is the provision for substandard? Everything they are asking. Just wait. Okay, effective cost of deposits. What is the effective cost of deposit? You see the question. A bank has got deposits at an average percent of 6.4. Okay, so this I wanted to put animation. Okay, by mistake I have not done animation. Can I do animation? Then it will be interesting. Okay, so what I will do, animation. Yes, fly in. Okay, now I will do slideshow, current slide. Okay. Friends, yes, a bank has got deposits, boss. I think all of you are seeing the screen, no? Yes. Okay, great. A bank has got deposits at an average cost of 6.4. Okay, they've got so much deposit, SP, current account, all fixed deposit. Overall cost is, average cost is 6.4. Very good. But CRR is 4.5. Okay, now right now CRR is 4.5. The question is, what is the effective cost of the deposit? This is the question you have to understand. What do you understand by this? You are getting 100 rupees deposits, incurring a cost 6.4, but the CRR is a waste, not a waste, is a mandatorily you are parking. Using 4% of my funds is used on zero income. The CRR will get you no income. Correct? Then what is the effective cost? This is how you have to calculate. How you got the 6.4? You are paying for what? The 6.4 is the cost for 95.5 rupees. What is the 95.5? Tell me, boss. What is the 95.5?
100 minus CRR.
Because the CRR doesn't get me any income, I am totally, though I am getting 100 rupees at 6.4, I am not using the entire 100. The 4.5, that is, I am deploying in zero assets. That is mandatory. So my available funds are what I am getting in my money, though I mobilize 100, 95.5 only remains in my hands. For that 95.5, my
Is it
cost
nothing
is,
but cost to deposit? Effective cost
yes,
means
yes,
deposit.
yes, cost of deposits. Okay,
So
so
that
the
remaining balance, if you have to give the
yes, you have to calculate. Yes, that is for 95.5, cost is 6.4. What is the 95.5? 4.5, as if I am not getting no income. So I have got this. So for 100, the cost will go up. So the cost you note down 6.4 divided by 95.5 into 100, 6.70. Strictly speaking, my cost of deposits is, my cost of funds are at 6.70. Huh? Understood? Okay. This is FIT cost. Okay. Now we are coming to, yes, why FIT cost questions are asked. Now coming to ABC Bank has got 300 crore. This is another beautiful question. Now, how to identify the maturity bucket? Next question. ABC Bank has got, okay, please.
Yeah.
Mute mode, boss. When you talk to your friends, okay, that's a problem. Okay. When you are off the screen, please mute. When you are on the screen, when you ask question, unmute. Okay. Now you see the question. ABC Bank has got 3,000 crore SP account. In what maturity bucket you will put? There are 10 maturity bucket. I think the question is coming afterwards. You are well aware. There are 10 maturity bucket. Now SP account in which bucket you will put? SP account which bucket it is RBI guideline. Note down RBI guideline. 3,000 crore because SP account why you cannot put in a particular bucket is a demand deposit. When it will be drawn, who knows? Agreed or not? Logically, SP is a deposit which has no maturity. Okay, it may be 1 day, it may be 1 month, it may be 30 days. Sorry, it may be 1 year, it may be 3 years. Some SP deposits are there up to 10 years also. Now, RBI is giving a thumb rule. What is the thumb rule? Remember the thumb rule. SP means 10% will be placed in 1 to 14 days. So that is 1 to 14 days cumulatively. Okay, 1 to 14 days consist of 3 buckets compressed. Overnight bucket, 2 to 7, 8 to 14. So 1 to 14 days, that what does it mean? In the next 14 days, 10% of the SP may be withdrawn. The remaining 90, don't think it will be withdrawn immediately. It has to be grouped in 1 to 3 years bucket. This is RBI rule. If you know this rule only, you can do maturity analysis, the gap analysis. I think one of you please mute. Okay. Yes, boss.
Sir,
Who is that?
what about this 14 days to 1 year, that time gap?
Huh?
What about the
This
time
one.
gap between 14 days and 1 year?
14 days to 1 year. No. This is
Yes,
RBI
sir.
guideline, madam. This is RBI rules. RBI is advocating based on the experience. SP account, 10% only you categorize in 1 to 14 days. The remaining 90% you place in 1 to 3 years bucket is a thumb rule RBI has told. Understood? Okay. Now come to current account. Current account, how to recognize? Current account, what's the maturity? Tell me, boss. Current account, what is the maturity? Current account has no maturity.
No
Okay.
maturity.
Then which bucket you will put? Now the question arises. So for the purpose of
15%.
analysis, 15%. So
Sir,
here,
here 15%
not
of SB.
not
Actually, SB
mistake.
only 15%, sir.
Yes, it's a mistake. It's a current account. Okay, I will correct it.
No, sir. Actually, 15% is for SB only, sir. Current account 10%, sir.
5%?
10% is for current account, sir. 15% is volatile for
Oh,
SB account.
is it? Is it? Okay. So I have only ulta, I think. Oh, correct. You are correct, madam. Shall I check up?
No,
Okay.
sir, what you
Yes,
are
sir.
saying is right. No,
SP,
sir, what you are
madam.
saying is right.
Current account only 15, madam. Correct. In a current account, withdrawals will be still faster, Okay, correct or wrong? Current account 15% will be placed in 1 to 14 days. SP account 10%. Check up whether it is correct. Yes, correct. Okay, very good. Okay, wonderful. You are alert. You are very alert, Appa. Okay.
Can you share all these bucket thing?
Yes. I am sharing, madam. Wait. Okay. So the 4,000 crore current account is there. So question is, how much will be placed in 1 to 14 days? How much will be placed in 1 to 3 years? Is RBI rule. RBI rule tells 15% you have to put it in. 15% of the current account that will be likely to be withdrawn in the 1 to 14 days. 88% will be likely to be withdrawn in the 1 to 3 year. This is a thumb rule by RBI. So 4,015 crores means sometimes they will give the data also. 600 crores will be in 1 to 14 days. The remaining 3,600 crore of current account will be placed in 1 because this arises only when there is no maturity. Otherwise, in the respective bucket, you have to classify. Respective bucket. Term deposit, respective bucket. Some term deposit 1 month. Some term deposit 3 months in the respective bucket. But when there is no this one, we cannot identify in that. RBI is giving a thumb rule. Okay, next question is maximum negative gap in overnight bucket. This already discussed. Anyhow, 5%, 10%, 15%. This one slide just to have an idea what are the standard buckets for some specific assets or liabilities. SP is specific because it has no maturity. That is why 1090. And the current account 1585. A overdue deposit, remember, old deposit whenever they have given, you have to classify in, you have to put it in 1 to 14 days bucket. These are the standard. Okay, only few, easy to remember. Cash, how will you recognize? Cash, how will you recognize, boss? Okay, cash, they are telling 1 to 14 days. Is
Immediate.
inflow? OD deposit, where you will put? Inflow or outflow? OD deposits are here, that also your SP, inflow or outflow? SP is an inflow or outflow? Outflow. Because SP is a fund you have to pay back. So it's an expected outflow. Current account, inflow or outflow? Outflow. Yes, OD deposit, expected inflow or outflow? Outflow. And cash, inflow. No, cash is not outflow. Cash is in your hand, it's an inflow. It is the asset side, Whatever on the asset side, inflow. Okay. So cash is 1 to 14 days, you have to group it. Premise and others, you will not sell it, but it is a inflow. Nobody will sell it. Yes, it will be grouped in over 5 years packet because it has no maturity, And investment in subsidiary, the RBI thumb rule is you have to classify in over 5 years packet. This is a thumb rule by RBI. Some banks are investing in subsidiaries. So that investment for the purpose of gap analysis will be over 5 years. Suppose inter-branch accounts, I am due to that branch, this branch, 1 to 14 days only. Okay,
sir, this overdue deposits, this is considered as a current liability.
Yes, this is a current liability.
Once it is renewed, it will be a term.
It will be in the respective bucket. It will be in the respective bucket. Okay. But overall, overdue deposit, as long as overdue deposit, you have to classify. Let it be renewed anytime. But thumb rule is you classify in 1 to 14 days bucket. Okay. Yeah?
Okay.
Sir, for that overdue deposit, there is no tolerance percentage like that.
No, madam. That will not the percentage that will arise only negative for the purpose of management, liquidity management. Remember, this and all no
Overdue deposit means mature deposit, right, sir? So
yes.
also a liability.
Maturity deposit, it may be withdrawn, it may be renewed. So, old deposit, which bucket you have to the balance it. Sometimes for calculating gap analysis, you have to classify in which gap, and that is why they are telling thumb rule 1 to 40 days you classify.
Entire amount will go, no, sir? Entire amount will go into 1 to 14 days bucket, no?
Yes. Entire cash you have to group in 1 to 14 days. Okay, single bucket. Sir, there is no single 1 to 14 days, no problem. It consists of 3 buckets, cumulative bucket. Overnight, 2 to 7, 8 to 14. Okay. So
and for this 5, 10, 15, 20 slabs are also applicable to this 1, 2 to 7.
Yes. Correct. So here they are telling the cash, okay, what you are keeping, you recognize in this bucket for the purpose of gap analysis only. Don't worry. It's only for the limited purpose of analyzing the gap. Where the bank is having negative gap, where the bank is having positive gap. Positive gap is not a thing to worry at all. Negative gap is the thing to worry. Over 1 year and all, nobody is going to worry. But short-term liquidity is the problem within 1 year or within 1 month. Okay, so this is how RBI is monitoring, especially this up to 30 days critical period. Now, which of this? Now I am changing the question because
Sir, please the previous slides, please. I want the maturity buckets common.
Okay. You can note down, madam, but I will share with you. Don't worry. I am going to share with you. Yes, these are the standard.
Not this one, sir. The previous one, common, like the 20 days, that one.
Okay.
Yes, sir. Okay. 1 minute, sir. Let me take a screenshot.
Yes. No problem, madam. Madam, evening you will get it, madam. Don't worry. I am going to send it in another maybe
the
by
previous
8 o'clock.
1 second. Can you just please go?
Yes. It's another few minutes. Okay, not few minutes. Yes, when the maybe I think last attack we are making on 8
The
o'clock.
previous one also.
Also,
already share the PPTs.
Yes, yes.
Sorry,
No
sorry
problem.
for the delay, sir. One.
Okay, okay, no problem, no problem. Okay, see, anyhow, you are going to get by 10 o'clock, it will be on your
One
table,
more, one
madam.
more slide, sir. The last one.
Yes, yes. The 10 o'clock, it will be in your table.
Thank you, sir. Thank you very much.
This is
Thank
the
you.
first bucket, second
Thank you very much.
bucket, third bucket. Okay, yes, fourth bucket. This here LCR. LCR is based on this. LCR means liquidity coverage ratio. LCR is basically first 30 days. 1 to 20, okay. Another 2 days, 1 to the LCR is for first 30 days. Liquidity coverage ratio. How to calculate the HQLA? Just wait. HQLA means high quality liquid assets. So the maturity bucket standard. Now question number 1 is which can be recognized. Sometimes they are asking this question. They will give something and they will ask you which of these shall qualify as tier 1 capital. Now note down the perpetual that comes under two category: cumulative, non-cumulative. Remember, the cumulative mean it will always go to tier 2. This is the thumb rule you have to remember. Cumulative mean what does it mean? In the interest and all, dividend and all will be added. Non-cumulative will be normally perpetual. Non-cumulative is better for the bank. That will qualify as tier 1. But when it is cumulative mean, normally it will go for that PNCBS. What is PNCBS? Perpetual, non-cumulative, preferential. I think all of you know what is cumulative, non-cumulative. So the non-cumulative preference share will qualify as tier 1. The long-term debt mean always tier 2. Anywhere debt mean, don't worry, straight away tier 2. Innovative so debt mean here it is innovative perpetual debt. Innovative IPDI, innovative perpetual debt instrument. IPDI is a new instrument with some inbuilt option. That is your call option. Always the innovative perpetual debts are those that are always issued with call option. What is call option, put option? Another few minutes you wait. The call option will be in favor of the bank. The perpetual bonds are issued with call option only. There will be no put option. Sir, what is the put option, call option? Put option means the rights will be given to the investor.
Sell.
If he wants to, what is call option, put option, madam? Call option, rights to buy. But here, call option means rights to redeem. Note down. Call option means rights to redeem a debt before the due date. Note down. Call option means the rights of the issuing company. You can note down the definition. Call option means rights of the issuing company to redeem the bonds before the due date or well ahead of the maturity period. That is called call option. Put option means the rights to pre-close or redeem. Now here you cannot use the word redeem. Redeem is always from the point of view of the bank or issuing company. But from the investor's point of view, pre-close, rights to pre-close, if it is with the investor or holder of the bond, that is called put option bonds. Put option bond, call option bonds. Understood or not? This question they will ask. Always remember, perpetual bonds are issued only with call options. Call option means what? Only the issuing bank, if they are ready with the funds, they can exercise, and that too only after 5 years. Not before that. The lock-in period is 5 years. Afterwards, they can exercise their rights to redeem before the due date. That is called call option. Understood? So all innovative perpetual debts are perpetual debt instrument. The short form is IPDI. IP, here I have not used the word instrument. So IPDI, that is innovative perpetual debt. This will qualify as tier 1. Tier 1 also under which category? Not under CET. There are two tiers under tier 1. Yes, CET and ATI. ATI means additional tier 1.
Additional tier
CET
1.
means common equity tier 1. That is core capital. This is additional tier 1. So the additional tier 1 only, this innovative, the perpetual debts are coming under. So what is the limit? We'll see. Wait. Perpetual non-cumulative. This is now question is which will be taken as tier 1? This is tier 1. This is tier 1. This is not tier 1. This is tier 2. This is also tier 2. C and D both. C and D both correct. So the answer is E. Okay, C and D both. Yes, C and D qualify as additional tier 1 subject to a maximum of, there also a ceiling is there. Anything you cannot. Additional tier 1 also, as per the Basel 3, it should not be maximum 1.5% of total risk weighted. Total risk weighted mean credit risk plus operational risk plus market risk. All put together, 1.5 is the maximum. Okay, already minimum is that CET is minimum 5.5. So 5.5 plus 1.5, 7. Okay, this is maximum, that is minimum. Then 2% is also maximum. Tier 2 is also maximum, not minimum. Tier 2 cannot go beyond 2%. Then CCB is 2.5 minimum. It can be maximum also. Somewhere it is minimum, somewhere it is maximum. Which is maximum? Tell me. Somewhere it is minimum, somewhere it is maximum.
Counter-cyclical.
Yes. Okay, understood. So
CCP and
that is how
CCP.
bank has built up.
Sir, what is
So the question,
TRWA?
yes, madam. Total
What
risk
is
weighted.
TRWA?
Yes. Total
risk weighted
assets.
Okay,
Total
thanks.
risk weighted assets mean, note down, credit risk plus operation risk plus market risk for the bank as a whole. For the bank as a whole, as on a particular date, on that they will calculate 1.5. That only is permitted to be, yes, put in additional tier 1 capital. Okay, this is calculated for the bank as a whole. Okay, friends. Okay,
Sir,
25.
Sir, I want to ask you that tier 2 will be limited up to 2%. Means upon
2% of the TRWA. TRWA means total risk weighted assets. Okay, this is maximum. Tier 2 will be maximum. Additional tier 2 also maximum. All others are minimum. You can also go for.
means in tier 1, if 5.5 can go up above.
Yes. That is the core capital. CET is a minimum. It can be even more, mean better. But additional tier 1, you cannot go on creating more. It is restricted to 1.5. Similar way, tier 2 also restricted. Yes, boss.
Okay, tier 81 is also, or tier 2 is also limited. Matlab.
Yes, tier 2 is limited. Yes, madam. Yes, boss.
So if the bank is, it's qualifying with the tier 1, and it's not having additional tier 1, then it can go with more than 2% in tier 2, right?
Tier 2, no. Tier 2, they are restricting to, because tier 2 is not a strong capital, boss. Tier 2 is only a shaky capital, is a secondary capital.
It's
that is why they are
2%.
restricting. They are restricting, boss. Okay.
Please, components of tier 1 and tier 2, sir.
You coming, madam? Don't worry. Coming. Already we have, I think. Okay. Now you understood what is what can qualify tier 1? What are the components? I think yes. Okay. That is, I think all of you are aware. Okay. Still, if you want, I can give you. The banks issue perpetual bond with the dash option. Which option? Tell me.
Call option.
Call option. Okay. That's the answer.
Call option.
And again, they will use the word 5 years is a lock-in period. They cannot exercise the call option within 5 years for the date of issue of the bond. They can exercise only after 5 years. Very good. Now another question. Now provision somebody
Sir,
was asking.
previous slide, sir. Previous slide.
Okay. Previous slide. Banks issue perpetual bond with call option only. No put option will be
They are
given.
asking only for screenshots, sir. No need to explain, sir. If they ask only,
No.
explain,
I'm
sir.
not. I'm not asking for the screenshot, madam.
Okay. Just to have a refresher. Okay. Very good. Okay. Now you come to the next question. Don't worry about the number. There is a good question because balance it, A pre-shipment advance, doubtful above 3 years. as on 31/2017 has a debit balance, that is outstanding balance 4 lakhs. Principal security 1.5 lakh. ECC cover 50. So these are the typical questions they will ask. You have to be very careful with the steps. Okay. Yes, doubtful. Now, what is the total provisions to be made in this account? Okay, answer is okay, but how to get the answer? Step by step we'll go. Yes, first one is a doubtful. How many years over? 3 years. So the general rule is, remember, even on secured and deficit, always you remember the rules for provisions for doubtful assets. Always
100%.
the 100% provision you have to make on unsecured component. The secured component, you know very well, doubtful in the first year, 25%. Doubtful in the second year, 40%. Doubtful in 3 years and above, 100%.
100%.
Yes. Now, how to apply this rule in this particular question? You go one by one. Now it's a 3 year. So 100, you keep it in mind. Now, what is the outstanding balance? 4 lakh. What is the outstanding balance? 4 lakh. That is a liability. Okay. So security available. First, you have to adjust the security for the purpose of deciding ECGC cover. ECGC will not give the limit on 4 lakh. Sir, 4 lakh, EC cover 50, so 2 lakh. No, no, no. First, you have to, notionally, you have to recognize the security. So 4 lakh, yes, security available is for 1.5. So the 4 minus 1.5, 2.5 is the, yes, amount. On that ECC will give how much? 50% only they will give. So 50% if they settle, 4 is the liability, 1.5 is the value of securities. So the 2.5 is the, yes, on that 50% is 1.25. Carefully you have to understand the steps. Yes. So ECGC settlement will be 1.25. They have not settled. This is the expected settlement from, yes, ECGC. Now, how to calculate the unsecured portion? Unsecured portion while you are calculating, you have to recognize ECGC cover also, security also. This is from ECGC and this is the physical securities available. Okay. So how much is now uncovered? 4 lakh is the exposure. 1.25 lakhs you will get from ECGC. 1.5 lakhs you are having the security. So the if you minus all that, 1.5 plus 1.25, 2.75. So the deficit is unsecured component is 1.25. For that 1.25, compulsory you have to provide 100%. So 1.25, 1.25 provision. And here 100% of the secured. The security is 150. That also you have to provide 100%. So the secured component also 150 is the secured available. ECGC you don't take into account. Sir, EC is also no. For the purpose of calculating unsecured only ECGC is taken into account. But for the purpose of deciding what is that secured component, okay, here ECGC will not be recognized. What is the security available? 150. So the entire 100% because more than 3 years. So 150, 150 provisions. So 125 unsecured. So the total provisions will be 275. These steps, one step if you miss, you will get a wrong answer. Understood? The steps are not.
Sir, this ECGC coverage is available for this unsecured portion?
No, 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 no. ECGC cover is different, madam. Unsecured portion, you have to calculate yourself.
No,
ECGC.
50% of total balance.
Yes, yes. Not total balance. They will never give on 4 lakh, they will immediately settle now 50. No. ECGC for the purpose of calculating ECGC settlement, this formula. First one you have to
secured value we deducted from the total.
Yeah, security you have to minus it. ECGC. Correct.
50% of unsecured portion we took for this.
Yes, yes. By calculating unsecured component, you have to recognize. I will give so many other examples, then it's only first example. Now, whether it is clear or not. Okay, MSME. This is one by one. This is a sure question they will ask. Okay. Yes. Now I will go next one. Don't worry.
Sir, unsecured portion.
Unsecured portion 100%, madam.
That
Unsecured means
2.5 minus 1.25 now, sir.
no. ECGC also you have to take into account, madam. ECGC also 150. Yeah, ECGC coverage is how much? ECGC coverage is 120, 1.25. Our security available is 150. So the 4 minus 150 minus 125. So here this 125 and this 125 you should not get confused. Unsecured portion also 125 is by default, by chance it has come. Somewhere it will be more. Okay. So here 50% of the 125. Sir, why 125 is coming? 125 coming, don't get confused. This is ECGC settlement. This is unsecured component in this exposure. That has to be provided 100%. Agreed? So these are the steps. I will give you for doubtful also, second year, first year. Then you will be. Substandard also they are asking. Now, one more question. All varieties. Investments of banks are classified into other than loans and advances, SLR, non-SLR, and grouped into how many categories? Main categories. The main categories are, yes, actually three. What is that? AIFS, HFT, HTM. This is not a category. Just to confuse you, to mislead you, they will give MTM. But they will not expand like this. Here I have told. There in the exam, they will only told AIFS. AIFS. What is AIFS? Available for sale. What is HFT? Held for trading securities. What is held for trading? Sometimes they will buy the share, they will sell the share only to trade and take care of the profit. But in AFS, sometimes some portfolio they may be losing. So before it is too late, they will sell it. Correct, some value coming down, will you not sell it? That is available for sale. But the HTM, nobody will sell. These are government securities. All SLR securities come under HTM category. SLR mean is a must, mandatorily you have to maintain SLR. So all SLR categories come to HTM category, held till maturity. No bank will sell in between. They will hold it till the maturity because they are pakka. Very first class government security. Anyhow, they have to maintain SLR. So these SLR security is also called HTM security. SLR is different. HTM, yes, all SLR securities are HTM. What is MTM? Is a concept. It is not a type of assets. It's a concept. Okay. Here, then exam they will not elaborate. Here, just to make you familiarize with the terminology, I have elaborated. What is MTM? Question they are asking. I think before the Corona year they had asked. Just before the Corona, I think they had asked MTM. What is MTM? Marked to market. Marked to market.
Helpful trading also, both are same, na? Mark to market and helpful trading.
No, mark to market is not is a nomenclature, is a concept, madam. But the held for trading is actually a name of a pool of securities. A pool of security, a group of securities will be marked as held for trading. Forex, always they will go on trading. Shares, they will go on trading. Sometimes non-SLR securities also, they will go on trading. But they will not trade on held till government securities, nobody will tell because they have to anyhow maintain SLR, So no, it's a first class security. No, they will not sell. They will not trade it. Okay. So the MTM is only a concept, just to confuse you. So the answer is A, B, C is the answer. A, B, C is the answer. F is the answer. The answer is F. In how many categories of assets, investments of the bank are grouped into? Now, next question they will ask is, which of these shall not be? This is another question. Yes, very often or repeatedly, FAQ is one of the FAQ. Which of these shall not be subject to MTM exercise? Okay, MTM is an exercise. What is MTM? Marked to market. Some securities, some rate will have occurred. Today, what is the rate? Whether it is a loss or gain for you. That is called MTM exercise. Okay. What is the MTM exercise? You understood, AFS available for sale. Whether it will undergo MTM, yes. HFT, yes, it has to undergo MTM because the rate will go on changing. Today market rate, gold, one simple example I am telling. Gold, whether you have to do MTM exercise. How many of you tell? No, yes. Gold loan you have given. Whether you have to do MTM. MTM mean what? Today gold, what is the value? What is the loan? That is called as MTM exercise. Whether you have to do MTM in gold, yes or no? Tell me.
Yes,
Yes.
yes.
Yes,
Yes.
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 You have given a loan on shares. You have given a loan on shares. Whether you have to do
Yes.
MTM? Yes.
Yes.
Why? Because the shares are highly volatile, fluctuating. So, but here, these two security, you have to do MTM. But the HTM security, no need for MTM. RBI is telling. So, only A and B, all the three, answer is D. Answer is C.
Answer is C.
Sorry. C. So, HTM securities are government securities, also known as SLR securities, shall not undergo MTM, mark to market. That is what is the market rate, whereas what is the cost of we have acquired. So is there going to be a loss? No, you need not have to worry, as they are nil risk securities. So the HTM securities are also called as nil risk security. Okay, so this you keep in mind. Now how much packets? That is a simple question. Don't worry. Earlier it was 8 packets.
10, sir.
Now they have made it 10 packet. What is the 10 packet? These are the packet. Overnight packet 1, 2 to 7 days packet 2, 8 to 14 days packet 3, 15 to 28 days packet. Yes, 5, 6, 7, 8, 9, 10. All more than 5 year. All our housing loans comes under this. Housing loan. Okay. Yes, like that. All big loan. Okay. Capital comes under what? Capital comes under what? Over 5 years. Okay, term loan respective. Something you cannot know. So, for example, premises comes under what? Land and building. Land and building comes under which
More
maturity
than 5
package?
years.
Over 5 years. Over 5
5
years.
years.
Correct, you know. So standard are there. So the sources of now this question also they will ask. This is quickly you have to remember. Now I will give the question. Now how many of you tell which is inflow, which is outflow? The question is sources of cash inflows for a bank. Out of these, which are the sources? Can you list any one of you quick? What are the sources?
Maturing assets.
A is inflow,
Yeah.
accepting deposit, inflow or outflow?
Inflow.
Yes,
Inflow.
Inflow.
Liquidation of investment inflow, maturing liability not an inflow, outflow,
Outflow.
premature closure of deposit outflow,
Outflow.
prepayment of loan inflow.
Inflow.
So, yes, 4 are inflows, 2 are outflows.
ABCF.
ABCF, correct. This is how as a random check-in they will do. Now, another beautiful question, because the maturity analysis, are you still remembering? I will do. Okay. Now the time is 5:15. You want a coffee break? Okay. Because
Sir, shall we
I
take a
think
break?
yes. I think I have got a session at 7, no? 5:30 or I think sir will come, I think.
5:30.
5:30.
5:30.
Yes. Don't worry. 5:30 you have to go for the next class.